Hi, everyone. I'm Bill Spence with Schiller Spence and Associates Private Wealth Management. Today, we're continuing our series on specialists that work with us. This is part two with our insurance and estate planning specialist, Chad Horner. Thanks for joining us, Chad.
Thanks for having me, Bill. Good to be here.
Yeah, I see you're wearing the same shirt as our last interview. So am I. It's kind of unique how it's tied together, but yeah, we did this in the same day, so everybody's watching us differently. We don't have just the same clothes, so appreciate that. So on a serious note, part one, we talked about the difference between term insurance and whole life, and the uniqueness and what's beneficial to each. Today, we're going to focus on as if we're business owners, and what is the importance role of insurance and how does it play in coverage and assets. So the first one we're going to talk about is a buy-sell insurance product for life insurance. So can you just give us an overview why and when we would use buy-sell life insurance?
Sure. So typically, any business owner situation, you would definitely look at having a buy-sell. A buy-sell agreement is actually a legal document that you would get drafted up at probably your corporate lawyers. That would make the most sense. And what it would do it would say, in the event of so and so passing, I'll use you and me as an example.
Sure.
Me and Bill are in business, and I go to the lawyer and say I want a buy-sell agreement. They'll say, okay, in the event that Bill dies, Chad, you have to buy his shares, and in the event that Chad dies, Bill, you have to buy his shares. So looking at it as exactly how insurance would fit inside of there. So going back to you and me, let's say we have a company and it's worth $2 million, nice round number. So the company's going to go ahead and purchase a policy for $1 million on my life, and then it's going to go ahead and purchase a policy for $1 million on your life. Now, the purpose of the buy sell is let's say I die, I prematurely pass away, and now all of a sudden you're business partners with my spouse, which might not be ideal. Maybe she hasn't had a hand in the business, doesn't really know much about the business, whatever it may be. She's maybe just not the ideal business partner. So now instead of you having to take $1 million out of the company to buy my shares from my spouse, that insurance policy is going to go ahead and pay into the corporation and give you the ability to pay for those shares without having to cash strap the corporation or yourself. So that's where the fit is.
Right. I mean, in that scenario, if our business is worth 2 million, we're 5 years into our business relationship, something happens to you, all of a sudden, maybe Lacey doesn't want to be part of the business. She's busy with the family. I don't want to be partners with Lacey, however it is. But at the end of the day, Lacey's going, hey, I want $1 million out of that company. It's my money. Now, if I don't have this product, right, now I'm going to the bank, either pulling it out of my savings or getting a loan to pay Lacey her $1 million. Whereas with the buy sell insurance, now we're using other people's money, and over 5 years, we would have put a marginal amount into it versus the million we're getting out, right?
Absolutely. And typically
Right.
you're looking at depending on the age of the owners. I mean, if you had a 50-year-old business owner, odds are you're probably going to write a term 10, right? So
Right.
the affordability is there, and maybe that 50-year-old wants out in 10 years anyway, right?
Right.
So
And as we talked about in the last part one, term 10, you could convert to a term 20 and so on. It gives you a little bit of flexibility. I mean, we could look at that. What about tax implications? So all of a sudden, as a company, Chad and Bill's company, you pass away, the insurance is owned by the company, it comes back to the company, so we get $1 million. Am I able to take that $1 million right out, write a check to Lacey, and no tax consequence?
yeah, that's a really good point. Typically, when you're trying to get money out of your corporation, you're going to take it out in one of two ways, and that's either a salary or dividend, which are both taxable events. The nice part about life insurance, though, especially held inside of a corporation, is it credits what's called the acronym is CDA, but it stands for capital dividend account. So what that means is that it's a notional account similar to your RSP room. You might have 80,000 worth of RSP room bill, but that doesn't mean there's actually $80,000 sitting there. So what happens is the death benefit of that insurance policy actually credits your CDA. Now you can go ahead and declare a capital dividend as the only surviving shareholder at that time, and you can go ahead and flow that $1 million out of the corporation tax-free through the CDA.
So when you say tax-free, I can't imagine there's many business owners out there that would mind having tax-free dollars, right? I think that's a pretty big win-win.
That's huge to get money out of your corp tax free. Yeah, I mean
Yeah,
that's the
win-win.
existential struggle is how do I get this money out of my corporation, right?
Right.
So
So we talked originally about our example, and I like that example where business partners value of the company's 2 million. As any business owner, our goal is when we enter business is to grow our business and make more money, right? We're not a volunteer group or anything like that. So let's say that same 5 years time down the road, our business has gone from 2 million to now 6 million. But we only had coverage for 2 million and now your shares were 3. What happens there? What part of our insurance can we utilize or draw on to cover that difference?
well, number one, that's a good problem to have. And
Yeah.
number two is so when we're looking at those business owner scenarios, we can actually add a rider onto term policies, and it's called a business growth protection rider. And what it does is we can choose the amount, a set amount that we can add on to the insurance every couple of years, provided there's a growth inside of the company. And we can do that without having to do any medical underwriting. Typically, the insurance company would want to see some financials just to ensure that the need is there, so you're not overinsured. But it is a nice option. I mean, insurability is not a guarantee, right?
Right.
So I mean, if we started this when we're 35, we should be pretty healthy. But if we're 45, 47, 48, like you said, your health changes, and that's just life. So
Right. So you just put that business growth rider on at the original onset of the policy. You can review on an annual basis what your goals are or what your financial needs are. There's no medical underwriting. Basically, there's only financial underwriting to prove that the business is worth what you're asking for.
correct. Yeah.
Perfect. What happens if all of a sudden, I like picking on you as my business partner. In this situation, you're in a bad car accident, right? You survive, but you're not coming into work for the next 6 months to a year. What about disability? What's a buy-sell disability policy?
Excellent question, and I think it is something that does get overlooked in a lot of scenarios. Um, I mean, you're a good guy, but I doubt you're going to want to keep going into work every day so you can pay me a dividend while I sit at home and recover for, it could be the next year, 2, 5 years, right?
Right.
Um, you know, after 6 months, you're probably going to get a little antsy and say, "Hey, I'm here, busting my hump," and Chad's still getting his share of the dividends, right? So, what we could look at doing is putting a disability policy in place, and what would happen? Let's use that $2 million valuation again. Is in our buy-sell agreement, maybe we have a section that covers disability, and it says after 365 days. If Chad still isn't, if he's still declared disabled, Bill now has the opportunity to go ahead and buy those shares from Chad and remove him from the corporation. And that disability policy is now going to pay Chad and Bill's company and then afford you the opportunity to buy those shares from
Right.
myself or my spouse. Yeah.
I think in both situations, you touched on a key part. This isn't just applying for an insurance product. You also need to be reviewing this with your lawyer, setting up that shareholder agreement. That's the true base of it. And then the insurance plays a large part in protecting it as you move forward.
For sure. I mean, it's one of those things that gets overlooked, and it just costs you money, man. And it's the worst thing in the world till you need it,
Yeah.
and then it's too late. But it's definitely something we recommend getting set up. As soon as that corporation is up and running, and just so you're covered.
Right. Perfect. Okay. Staying with the business owner theme, you and I are a business. We're using that concept again. Let's say Ilkin. Ilkin is our top sales guy, and he brings in the majority of our sales. And what can we do to protect him if something ever were to happen to him in the event of loss of life?
Sure, another good question. We could do what's called a key person policy, and I'll use Chad and Bill Co. for example again. We do $1 million in sales annually, and Elkin's responsible for $750,000 of those sales. So arguably, he's a very key part of our business. So what we could do is put let's say a $400,000 policy on Elkin. And in the event that he passed away, heaven forbid, what would happen is, again, the corporation would be the owner and the beneficiary of it. But what that $400,000 would do is let us go down the street to Billy Bob Co. and take their top salesman. So that would provide us a year's worth of salary plus a healthy signing bonus to bring him over, and hopefully he could fill Ilkin's shoes at the end of the day. Again, it's more about affordability and not trying to tie up our money, and we can use other people's money, right? It's a cost-effective solution.
When you say, I mean, how do you come up with that amount to saying 400,000? What underwriting goes into that to prove Ilkin's worth to our Bilco company, right? Bill Chad company.
So I think arguably if we were paying Ilkin a $200,000 salary, we could say, well, I know Billy Bob Co. down the street's paying their top sales guy the same thing. So we're going to have to offer him a little more, plus he's happy there. So what's going to draw him over? Well, maybe a nice signing bonus would bring him over as well. So I think as long as you can justify it on paper, there's not an issue. So
within reason, right? I mean, everything's underwriting, so there has to be a reason behind it. If you can justify it, they'll underwrite it. You pay the premiums. If something happens, then you go. My question is, in our situation, is Ilkin really worth that much? I mean, we're not sure, right? That's something we'd have to debate. We'll come back to that later. Okay, now we're going into treating whole life as an asset from a business owner. And so inside a company, our goal is to make money. So we're building cash inside of our, non-registered bank account and so on. How can we take that cash, move it to an asset, which we call a whole life, or in some cases an estate bond? And what is the benefit for you as the owner by doing this?
Yeah, that's a good question. So typically when we're talking, corporate insurance, we would recommend you hold it inside of the corporation for a number of reasons, right? Probably the most important reason being though, to pay for that dollar premium, personally, you're going to pay 35-40% tax on that dollar, whereas inside of your corporation, it might be, 12% tax to make that same dollar. So holding it inside of your corporation is beneficial from that standpoint. But the nice part about it is, again, we'll go back to that question: how do I get assets out of my corporation? Right? That's always the struggle. And if we use a whole life permanent product, that's one way to do it, and we can pay for it with a corporate dollar. And then also reverting back to that CDA, capital dividend account again, that's going to give us the ability to get assets out of that corporation tax free. Now, there's a number of things we could do with that policy. That everyone hears insurance and they just think, oh, it's an expense, but it can actually act as an investment vehicle to replace a significant chunk of your fixed income inside your portfolio. It's more for safe money. You can't have a negative rate of return on it, all these things, right? And you could do a front end leverage on it. You could do a back end leverage on it. There's lots of different things. Those are conversations for another day, but worthy of a discussion. And they're always case by case, right? It depends on what the client's comfortable with and their situation.
So a couple things that you pointed out in there, and I'll just kind of readdress is, one is it can replace some of your fixed income, right? So, I mean, when we're dealing with business owners, that money in their savings or in their bank account is their safe money, right? They had enough stress and risk in their business operations, so they've worked hard to build that cash. They may not want to put it at risk in a high equity or so on, so maybe in a fixed income. By taking a piece of that investment and putting it into a whole life, now you've got a dividend paying cash value inside of it. And I'm not pumping Canada Life's tires, but they've paid out a positive dividend since 1846. So throughout those last 160 years, it's paid a positive dividend. So there's a track record there. So it gives you that security. And also you can get that money out, as we mentioned before, through your CDA account, and there's tax savings and so on. So again, sit down, see if the right fit is with your advisor, and make sure that it's the right fit, the premiums are the right fit for your budget, and so on. The other part I brought up or want to bring up is corporately owned versus personally owned. So as business owners, you'll notice that everything they can pay through the company, they funnel it through the company, right? I mean, go through there. Any expenses, I mean, you got the accountants working with them to do that. What about on an insurance basis? When should it be personally owned? When should it be corporately owned? What about the uncertainty of that numbered company or that company maybe not existing in 10 years and we're entering a whole life? Maybe we should have it personally versus corporate and the implications of that and so on. Lots of questions in that, but just kind of give us a brief overview on that.
Sure. Yeah, lots of moving parts there, but we'll try and get through it. So, the number one thing there, again, what I touched on just prior was the taxation issue. Versus paying corporate tax on that dollar versus the personal tax on that dollar. That's beneficial to hold it inside of the corporation. Just kind of shifting gears for a minute over to living benefits. So, and what I mean by that is critical illness protection and disability protection and long-term care protection. Referring back to the CDA, I said life insurance credits that CDA account. Living benefits do not. So if you had a $100,000 critical illness policy, you got sick, it paid out, and your corporation was the owner. Now that $100,000 is inside your corporation. Great. How do I get it out? Right? Well, salary or dividend. You're going to pay tax on that benefit. So that is definitely worthy of some number crunching and a discussion to make sure, well, maybe I should hold this personally, but I'll hold my life insurance corporately, or there's different avenues to look at there for sure. When you said if maybe OPCO is going to be sold down the road, do I want to have my whole life policy in there? Short answer is no. You don't want to have it in there. It is a taxable event if you go ahead and try and remove it and put it into your personal name. Typically with our higher net worth clients that are looking at strategies like this, we're going to advise that they open up a holdco, and we're going to go ahead and put that policy inside of the holdco because we're never going to sell holdco, right? So, very good questions though.
Yeah. And I think that's, again, where we're working with our clients, with their accountants, making sure everybody's on the same page, not for just what's good for them in 2021, but we're looking down the road in 5 years, 10 years, 30 years down the road. So, yeah, great. You touched on living benefits. I'm excited to say that'll be part 3 of our insurance discussion with Mr. Chad Horner at a later date. But again, we covered buy-sell insurance, buy-sell disability, key person, the tax implications, corporately owned versus personally owned, the benefit of having an insurance inside the company and growing that cash tax-free. So lots of great conversation pieces. If you want follow-up or if you have any other questions, feel free to reach out, 780-874-4415, or contact me by email, and our team's email are located on schillerspence.ca. So thanks again, Chad. Very valuable information, and I appreciate your time.
Thanks for having me, Billy. Take care.
Speaking of time, when I talk to you, time stands still. You got to change your batteries in your clock behind you. Anyway, thanks for coming. Perfect. Thanks,
Billy.
Bye.
Take care.
Yep.